Good morning, folks. I hope you've had a great week and a better weekend ahead. There's been some very interesting action from SEBI concerning mutual funds. Okay, and some of them directly impact the way we are going to be looking at portfolios. Okay, so I will just be speaking about these two aspects. In any case, markets have been rather lackluster the entire week, with a slightly downward trend as far as India is concerned, and a slightly more optimistic trend in the US. Okay, as we have said earlier, markets are becoming immune to the actions regarding tariffs or any other geopolitical issues. Okay, which is, I guess, okay, as long as it doesn't get excessive. And Q1 results have been coming in fast, and couple of observations there. Sales in Q1 for the sample of 135 companies is only up 4.7%, and net profit is only up 6.1%. So net profit at 6.1% is half of what it was in last Q1. So Q1 of 2024, net profits were up 11.9% for this kind of a sample size of companies. Markets are these results are a little underwhelming. Let us bear that in mind. And another reason why markets are not likely to be running away anywhere soon, not this year, till profits and earnings show a distinctly better trend. Okay, so back to the action from SEBI. So one of the most interesting things, the headline reads, SEBI plans a revamp of MF norms to curb the clutter. Okay, amongst the 4-5 recommendations that they have made, one really stands out as far as a portfolio builder is concerned. Okay, and SEBI says that any two schemes of the same asset management company should not have a stock overlap of more than 50%. Very interesting, because we do find that the multiple schemes that asset management company runs, okay, and in some of them the overlap is so high, it just doesn't make sense to have two schemes of the same asset management house, because 60-70% in some cases are similar holdings in the portfolio. So we are not getting true diversification. Even if one were to take schemes from different asset management houses, we do find that the overlap is pretty high. So even, for example, if I take the flexi cap schemes of all asset management companies, I would find that in many cases the overlap is greater than 60%. Okay, then how are we getting diversification? Okay. For somebody like a serious wealth manager who's trying to construct a portfolio with non-correlated assets, when I say non-correlated assets, means we don't want the assets to move in a similar manner with the same magnitude in the same direction simultaneously. Okay, so we want assets to behave differently, so that overall as a portfolio you get a better behavior. Okay, so it's called building assets of non-correlated varieties. So debt and equity are non-correlated, for example. Okay, the behavior of debt in the market is different from the way equity behaves at the same time in the market. But within equity also, we try to get non-correlated assets. And when we are constructing the portfolio, we look at the coefficient of correlation to try and figure and identify schemes which have low correlation with each other. And believe me, it's very difficult to find enough schemes that have a low correlation with each other. Okay, and if now SEBI is telling asset management companies to have a lesser overlap, a lower overlap, it is great for scientific portfolio builders like us. Okay, and that means better results for the investor. So that is the one interesting thing that comes out of SEBI's recommendation to asset management companies. The other headline reads, mutual funds turn up the dial on active factor funds. Okay, so it so happens that a number of asset management companies are not just putting out factor funds, but putting out active factor funds. So how are they different? So far we've seen factor funds, or what we call smart beta funds, following that particular factor index. For example, if you had a low vol 30 smart beta fund, it was following the low vol 30 NSE index. Okay, so in that sense, since the index is passive, the fund is also passive. But within that, if you're trying to say that, hey, though this forms part of the low vol index, or this is a low vol stock, I don't think this stock has a great future. I don't think this sector has a great future. So let me take this particular stock or this particular sector out of the index and look at the rest of the low vol stocks. Then that is active management. So funds are trying to come out with actively managed momentum funds, actively managed quality funds, to try and take out the stock biases or sector biases from the index. It's quite new, so let us see how it pans out. I'm not too sure of what the result could be. And as we always say, wait for a couple of years and see the results and then decide. That's the best way of dealing with your money. But many people ask me, why at all factor funds? Or what are factors? Okay. So to put in simple terms, factors are the basic building blocks of performance. If a manager comes and says, hey, I've got a 5% alpha, that is a 5% outperformance, we would like to go and break it down as to the basic element and see what was it that caused that particular alpha or outperformance. Okay, and as you keep breaking down, okay, you may say, all right, the market went up by 10% and the fund did 15%. Yes, that's a 5% alpha. Okay, but what caused that 5% alpha? You skip. Okay, the fund manager was overweight mid-cap stocks. Okay, and mid-caps ran up much more than large caps. So you would have got a outperformance because of just simply holding mid-cap stocks. Or you could have got outperformance of just holding value stocks at a time when value stocks were doing well. Okay? Regardless of what that particular stock was, in general, all value stocks went up, or all mid-cap stocks went up, all small-cap stocks went up. So by virtue of holding these category of investments, you had an outperformance. So one can keep breaking down the reasons, the causes for outperformance, and then you come to what are called basic factors. Okay, and these factors we broadly classify as momentum, low volatility, quality, value, and growth, etc. Okay, these are the basic factors that most managers would agree on. What is momentum? Okay. Momentum is the manager is trying to identify stocks which are growing at a rapid pace. Okay, so that rapid pace is known as momentum. If you're able to identify stocks that are continuously growing at a pace higher than the rest of the market, it would come into your momentum radar. Of course, there are a lot of statistical formula that go into identify these stocks and to maintain the consistency of the framework. Okay. And the belief is that if a stock is doing well, growing at a good pace, it would continue to grow at a good pace. That is what momentum is all about, if you were to borrow from physics. Okay. But the indices don't sit on the same stock. They do rebalance. Every 6 months, they look back and see which are the stocks that are falling under the momentum, the best growing, the high stocks with the highest momentum in that particular universe, and they rebalance. And that is how, over the long term, momentum does give an outperformance versus the base index. Okay, but momentum has its drawbacks. Okay, if the markets are falling, then momentum falls at a more ferocious pace. Just like if a market is going, it goes up more rapidly. Okay, so this is what we call pro-cyclical behavior, and it's great to have some momentum, depending on your risk attitude, of course. On the other side would be low vol or low volatility. So here you're trying to identify stocks which have exhibited the lowest volatility, just the antithesis of momentum. Okay, and something like low volatility is good to have because they give you a solid bedrock to your equity portfolio. When markets fall fiercely, low vol gives you a cushion. Okay. For example, during the COVID drawdown, the initial part of COVID, we had a severe drawdown, okay, or in the time when we had enormous geopolitical uncertainty. So low volatility index exhibited a lower drawdown than the broader index. So you wish at such times that you had some amount of low vol. So that is the kind of benefit a low vol can bring you. Okay, and then you have quality. Quality simply means companies with very strong balance sheets. Okay, so again, in times of trouble, the businesses that will exhibit maximum resilience are those with a strong balance sheet. So at such times, quality has a role to play. Okay, and generally quality consists of a lot of defensives, FMCG stocks and staples. Okay, or even some of the large banks and IT companies would typically fall under the quality umbrella. And then you have value. So value refers to those stocks which are undervalued based on PE or price to book or price to earnings and so on and so forth. Okay, so one can combine these factors in different weightages at different times to get the best result out. Okay, so there is a science behind it. I always say don't try it out by yourself. Just like medication, self-medication is never a great idea. Try to understand the science or take the help of an advisor who knows the science and then do it. But I think factor funds are some of the best things that have happened to Indian stock markets, Indian mutual funds, and it's a great way to figure out how and build a portfolio to your taste. Okay, so depending on the economic cycle, you may choose to have some factors and eliminate other factors. Okay, and that is where the trick is, and it's a great science. So I hope that's enough food for thought for this week. Have a great weekend. All the best.